That working? Seems to be. The last session of the day. Well done for staying around for this. First off, you might notice that we're missing somebody. Matt Theodorakis from Irish Management, unfortunately, has caught the dreaded influenza back in London, so he couldn't even step on a plane. He was so ill. But my guests here tonight, Joe and Miguel, they're actually quite happy about that because they get to actually speak a lot more than if Matt were here. But anyway, so our final panel is really looking at what is rapidly becoming the shrinking distinction between private credit and the broadly syndicated loan market. I mean, once upon a time, they were very, very distinct. But I think, as we just heard, it was Ted from Monroe, just on the prior panel to this, who said that they're now bumping up against each other. So we're going to explore this a little bit, really ask ourselves, is that actually happening? Why it might be happening? Where is it happening? Because I said they were once very, very distinct, whether that be in pricing, whether that be in liquidity, whether that be in documentation, and dare I say it, whether that be in underwriting standards. So I'm going to start then just asking that question: to what degree do we think this sort of defining line is being blurred? And if so, where's that most being seen? Which segment of the market, but either in size or geography, are you seeing that? So, Joe, why don't we start with you, if I may?
Yeah. I think, no, there we go.
It is.
So look, firstly, Jack, thanks for having me. It's great to be here, and thanks to AIMA for hosting this event. For Baring's private credit strategy, we have a real long-standing focus on middle market, and we're relatively disciplined about that. And for us, that means EBITDA at origination of somewhere between 10 and 75 million in local currency. And so, for us, that's where the mid-market sits. Now, it is clear that there is an increasing convergence the further up that scale you go. And I think it also varies by region. So my strategy, which is the European strategy, we very much see that deals below 40 million euros of EBITDA still look and feel like mid-market deals. And as you go up in size, you're seeing increasing convergence. I think in our minds, they're fundamentally quite different products and propositions. And for LPs, I think that the discipline on strategy and focus on middle market is important. So all of our loans in Europe continue to have financial maintenance covenants. We think that's appropriate from a middle market perspective. Spreads continue to be circa 200 bips wide of the broadly syndicated equivalent yield. And we think the middle market offers that nice balance of attractive risk-adjusted return as well as good controls in the documentation. The challenge is very much as borrowers graduate up and grow under our ownership, and that's where we see increasing convergence, slightly different deal styles. But for us, it's, we welcome development of increased financing options at the large size range, because it gives us an option to exit the deal. Whilst a lot of the chats around deployment, we need to return capital to investors as well. So having that function at the larger end is important.
So I can see already here, Joe, that the competitive dynamics that seem to be evolving are not really troubling you too much at the moment, given where you occupy, the sort of space you occupy in the middle market. But Miguel, turning to you, what's your answer to that original question I asked about kind of where you're seeing it and how is it impacting you?
Yeah, absolutely. Thank you, Jack, and it's great to be here and to speak to everyone. I'm Miguel. I'm part of CVC within the credit team as part of our executive committee in private credit. So at CVC, Jack, we focus on the middle market direct lending, same as Joe does, where companies tend to have EBITDAs 25 to 75 million euros, and there you're not seeing as much convergence as Joe said. Just to flag also that the direct lending market, as some other folks have said earlier in this conference, encompasses, $2 trillion plus of AUM across multiple different strategies. So, for example, we have capital solutions at CVC, which we do junior capital lending. That's something I focus on, where there's not any convergence with the broadly syndicated market. So, just to contextualize it, we're speaking about large cap corporate companies that have the ability to access the syndicated markets because they're large and they can access liquid loans. And then you've got the direct lending equivalent at that large cap level, where there's some convergence in documentation and a bit in underwriting standards and a bit in spread. But again, in that mid-market layer or in the non-traditional direct lending senior layer, there's not that much convergence, especially in Europe.
Yeah. So, we definitely seem to see it's happening in the upper end. I don't know where we have it, if there's a cut-off line, but certainly 500 million plus sort of size deals is kind of where the competition starts to be felt acutely, and it goes up from there, which actually will sort of, that might bring us on a little bit later to ask the question: is scale an advantage or a disadvantage in many ways, if that's the sort of space that you are competing in? Geographies, I mean, I know you're both European focused, it seems to me, and from what I hear, this sort of narrowing of the distinction between the two is happening more in the US than in Europe. But is that your understanding?
Yeah, look, I mean, Baring's wider platform, we're getting close to $500 billion of AUM, and that covers multiple regions, multiple strategies, including a very large and long-standing public credit strategy on the sub-investment grade side. So we're well placed to spot where the convergence is happening, and I would say the US market is probably, and always is the case, a few years ahead of Europe. Fundamentally, the US is a more efficient market than Europe from a private credit perspective. It's a homogenous currency, language, business region, and you've got multi-party deals happening really all the way down into the mid-market, and you're seeing Covlight penetrate further down into the mid-market. I think for Europe, it remains, a market that has higher barriers to scale. I mean, barriers to entry are low for anyone. Anyone, can set up a private credit fund, but having the critical mass, the team scale, language, cultural ability to drive origination to create the portfolios favors managers with scale, and so we see kind of more consolidation of the market in Europe, and I think that just makes it that little bit harder for the same trend to become true, although we do see signs of it at the very large transaction size, as you say, typically above $500 million of financing volume.
Yeah, and you mentioned there, some of that's being manifested in covenants and more covenant-like deals going on. I mean, Miguel, I mean, if we agree that this narrowing is happening, where is that most being felt? Is that or being manifested? Is that in sort of the underwriting standards? Is it in the covenants? Is it in the documentation? Or is the competition mainly at the pricing end? Or is it just where are you seeing it most, or where is the market seeing it most?
Yeah, absolutely, Jack. So I think when folks and when we think about convergence, it's typically in the documentation side where a lot of people are focused, because obviously you've had the two big recent examples in the US around Tricolor and First Brands, where and now there's a lot of noise around Altice, where arguably because of weaker documentation, it allowed the borrower to do things that may take value away from the lenders, in particular the senior debt lenders. Just to flag, of course, that is not direct lending the way we do it at CVC and the way Joe does it at Barings. That's more a feature of the syndicated markets. And so, there is that perception that the documentation at the upper end is weaker, is looser, and gives rise to potential negative outcomes for lenders. Now, if you just broaden the brushstrokes, underwriting standards is certainly the bit where we see very limited convergence. I think the way that senior lenders who can tap into the liquid loans think about underwriting is different. There'll be a huge credit element, but obviously they have the benefit, and we have a huge CLO platform, so we know this. They have the benefit of liquidity, so they can trade and sell loans once they have a differing credit view. But because in the direct lending segment of the market, we're very focused on making long-term loans to companies, we have to take a very long-term horizon underwrite. And so we tend to favor having strong, deep underwriting standards and ensuring that we know the companies inside out, we know the sectors, and we know the management teams and the private equity sponsors that back them. And then you could go into what does that mean, in terms of outcomes for returns. Typically, there's an illiquidity premium, as Joe mentioned earlier, on the private credit side, which has been maintained. We see that as being 200 to 250 basis points, as Joe said, possibly even more, depending on which jurisdiction you're looking at, which has been the case. So, you're not really seeing convergence there. So I think, to answer the question squarely, Jack, it's really on the documentation side and the ability for companies, if they're in sticky situations, to take value away from senior lenders and potentially give that to the private equity sponsors or to new lenders. That's the big focus area. And that's not really a direct lending theme. That's a more syndicated loan theme.
Yeah. No, that is interesting. I hadn't realized that actually that illiquidity premium and pricing had actually been maintained while all this is going on. So that's really
Yeah, there's always a deal where everyone
Where
talks
it's
about it and it hasn't been. But if you're a scaled manager, you're not looking to do one deal. You're looking to do. We've done 60 deals in the last 12 months, including portfolio add-ons, and so making sure you've got a wide range of price points to deliver that average, which gives the investors and the portfolios the illiquidity premium they need. But you need scale to do that. To have that sample size.
So I wonder how borrower behavior is changing. I mean, the great thing about private credit for borrowers is the certainty of execution, the flexibility of the structuring, the kind of speed with which they can do it, which you historically haven't been able to see in if you're borrowing through the syndicated market. Do you find that the borrowers, certainly the deals and transactions that you're looking at, that is still very much to the fore of what it makes them come to you rather than go to the syndicated market where they are going to get it at a lower price?
Yeah, I think price is an important input for GPs on the private equity side when they're running their returns, but there still remains a very compelling case for private credit. That can be speed, as you say. It can be confidentiality around something like a take private, a P2P, for example. Buy and build strategies and their execution do not favor broadly syndicated financings. The BSL CLOs do not like undrawn capital, whereas the capital bases of folks such as Miguel and myself, drawdown funds, SMAs can provide that committed capital on an undrawn basis. So there are a lot of reasons that there's sometimes a complexity or a rating challenge which favors private credit, and time and again you see large sponsors, who are really the kind of borrowers who decide what goes on. They'll explore both options, but private credit year over year continues to gain share. Where is there more white space for private credit to gain share? It's in that larger financing size where the broadly syndicated market, which is bank originated and distributed, has a larger kind of share of the market today.
Yeah. Miguel, do you see anything different to that?
Yeah, I think Jack, Joe's spot on in terms of the borrowers and the way the companies are reacting to it. They are looking to maximize the flexibility they can receive across both syndicated direct lending and also, syndicated loans and also direct lending. And each situation, to the extent that we can be a solution provider, and at CVC we look to provide 100% of the debt backing either an acquisition, refinancing, or traditional LBO, that allows us to have more control of the documentation and more interaction and direct control in terms of the company and their actions, right? And so that's something we always focus on, trying to be the 100% solution provider, just to have that additional ability to speak to the companies directly and to speak to the private equity GPs directly and control the documentation, so that from the outset, it's less likely that the companies and the private equity sponsors and the borrowers will look to take advantage of the relaxed standards that there may be in documentation.
Yeah. So turning from borrowers, I'd like to sort of focus on the investors. And I mean, it would seem to me that that LPs are becoming more and more sophisticated. They understand this market better than they ever have done, and they've got a choice. What they can get in the syndicated loan market is liquidity. What they historically haven't been able to get in the private credit market is liquidity. Are you seeing any change in investor behavior? I mean, you say that the premium is still there, so they can still get better returns in private credit, but is that illiquidity premium sufficient at a time when they're looking for more, perhaps potentially looking for more liquidity?
Yeah, look, I think investors are becoming increasingly sophisticated. I think LPs see the difference between a middle market strategy that has differentiated origination and unique portfolios that are diverse versus just taking a ticket in the same deal that 5 other managers are in. I think, I'd contrast the kind of alpha that's generated in option A versus the beta that's generated in option B. And I think they're becoming smarter about that. And that favors those managers who are scaled, have discipline around their strategy and a long multi-year track record, which is driving consolidation of capital towards those managers, in our view. In addition, I think, GPs such as ourselves are becoming increasingly, and it's driven by investor demand, good at serving complex and sophisticated LP requirements, be that via bespoke SMAs, be that via perpetual funds, be that via semi-liquid funds, or indeed via securitization. So we issued the first multi-currency private credit CLO in Europe this year, and that was really interesting to see how that securitization demand played out in the market for the first time. And unsurprisingly, very, very strong appetites from certain parts of the world for the AAAs, very, very good appetite for the equity from certain parts of the world and investor types. So I think having the scale to offer, a menu of options to investors and access points, at times, in the cycle is critical for managers.
So Miguel, in the conversations you have with investors, I mean, what always floats to the top as the most important thing that they are looking for? I mean, clearly, from my point of view, I think you invest in a fund, you get the diversification, you get the robust risk management, the underwriting standards and rigor that you have in that, way beyond price and liquidity. But is there any of that changing, and given the convergence that we're hearing and talking about in certain segments?
Yeah, Jack, I think, look, fundamentally, the absolute returns that we had 2-3 years ago have come down a bit, right? The base rates have fallen. Euribor has fallen from 4% to 2% as an example. So it is true that absolute returns have fallen. But if you look at what investors mostly want from us as credit investors, it's not to lose their capital and to return their capital. And so if you look at the default rates in the private credit market and default rates as relates to CVC, as an example, we've never had a realized loss to investors. Fundamentally, if you're a credit investor and you could demonstrate a very strong track record and show that you've not had any losses, I think investors see that as a huge positive, because at the end of the day, they're very focused on risk-adjusted returns. And so if you're able to deliver good absolute returns, but with minimum defaults, minimum losses, that's a fantastic outcome for investors.
Great. Well, all three of us can see the clock here, and we realize we haven't got very much time. And as this is the last session of our particular forum and summit here today, we're going to go a bit rogue. Forget the title that we have as our... I've got you both here. I've got you captive. It's towards the end of the year. Next year's a whole new year. We've heard a lot about private credit. Share with the audience your views, your hopes, your aspirations for next year for private credit and for your ability to be able to drive and generate returns for your investors.
Yeah, I think, funnily enough, I was rarely had 6.5 hours to myself yesterday on the plane and thinking about exactly this topic as we speak to the team before everybody goes away for Christmas. I think for us, the main thing, and it crosses a number of different areas, is you have the M&A boom vintage of 21 and 22 is going to turn over. And it's going to turn over mainly because it's going to be sold or put into continuation vehicles or refinanced as contractual maturities come into view. I think that's a critical time, and it goes to convergence because the vast majority of those assets have grown in size and scale. And so making sure that we can remain having capital to deploy to the borrowers that we know best will be kind of key performance indicator one for next year. And we're very keen to defend our incumbency and try and stay with those portfolio companies. I think the other side of the coin is that you're also going to see the ones that have not performed so well out of that vintage become current. And so making sure that your team is set up and your process is set up to act early and intervene to recover value in the names that haven't gone so well out of that crop. So I think you're going to see real ability for managers to overperform versus peers next year, more so than you have in any of the last 5. And so we feel good about that. We think we're well set up for that, but it's going to be a really important year next year as we try to retain the assets that we want to, as well as kind of manage through underperformance as those boom year crops become current.
Got it. So it's no longer a situation of the tide lifts all ships. This is quality of the manager, expertise, skill is really, really to the fore. Miguel, you've got the last word.
Yeah, absolutely. Thanks, Jack. So, look, we're positive fundamentally on direct lending in Europe. We think as rates come off, there should be an increase in M&A. If there's an increase in M&A, it should bolster the ability to do direct lending into those acquisition finance structures. I would say also, I look after and I focus on our capital solutions funds within CVC, and we're very bullish on that as a theme for 2026. In particular, we think that, we know that, Preqin has done some analysis, and there's $1.3 trillion of value locked up in the portfolio companies of private equity GPs in Europe today. And so that money needs to be returned to investors such as yourselves. And we think that capital solutions in the form of structured equity, preferred equity, pay-if-you-can loans, second lien will be vital to creating that DPI to investors on a very selective basis.
Brilliant. Well, gentlemen, thank you very much for joining me this afternoon. Well done for closing out, being the final panel of the day. Ladies and gentlemen, please show your appreciation for Joe and Miguel. Thank you. Thanks, Jack.